During the time that we're going to spend together this evening, we're going to be delving into one of the investment vehicles that has revolutionized the way people approach the stock market, exchange-traded funds, commonly called ETFs. But not just any ETFs. We're going to be focusing on the game-changing ETFs, low-cost exchange-traded funds. So what exactly are low-cost ETFs? Well, they're designed with a specific emphasis on minimizing expenses and fees associated with investing. And we'll explore the reasons why cost matters in investment decisions and how these funds can potentially make a significant difference in your long-term financial success. And also what is meant by the investor advisor's alpha. Now, as with any investment strategy, though, there are pros and cons, advantages and considerations to keep in mind. And we'll examine the various benefits associated with low-cost ETFs, from the diversification, ease of trading, tracking different markets and industries, and just to help you understand the full spectrum of the opportunities that these funds offer. And to do that, I felt who better than the pioneers of index investing and exchange-traded funds, Vanguard. Vanguard is headquartered in the US, but they do have a presence here in Canada, which has been for, is it exactly 10 years or over 10 years? We'll get our host or guest speaker to confirm that, but it's been about 10 years to my knowledge that they've been in Canada. And before we pass it on for Surenanthan to sort of go into his presentation, we'll do a quick Slido poll just to get a pulse, just for him to sort of get a sense of who's in the audience, what your experience has been with ETFs, and that will at least help him to determine where to focus on. And then after his presentation, which will likely end at about 7:45, maybe definitely before 8, then we'll lead into the Q&A, and I'll hang around for a usual Ask Me Anything session. So with that, I will sort of, for anybody who's joining for the first time, introduce myself. My name is Orlando Lopez, and I'm an investment advisor and a financial planner here at RBC Dominion Securities. Going on over 13 years in the industry. I'd worked for a previous financial institution, and then even in a previous life, I was in IT. I did computer programming. So I've worn various hats, in the past, and even in my current role, it involves wearing a number of different hats. I've also spent a few years teaching at York University, finance, so my passion is sharing information specific to finance, and I've been able to use this platform to do that. A curious mind is sort of, I'm always trying to learn, and as soon as I learn, I try to pass on that information. So happy if you're here joining us for the first time, and certainly hope it won't be your last. And let's get into sort of the roots and the history of ETFs. And we'll start off, as I mentioned, with a poll. So you can, go to slido.com, input the number 3763234, or if you have a mobile device, then you can sort of scan that QR code, and that will also take you there. So I'm going to pull that up here as well. Okay, perfect. And then I'll start off with the first question. So the first question okay. Were you aware of Vanguard prior to this webinar? So you've got the number on the left as well, or the QR code is just on the left. So were you aware of Vanguard prior to this webinar, or is it the first time that you're hearing about Vanguard? So we've got a few who've never heard of them, right? And a majority have heard about Vanguard in the past. Okay, tilted a little bit, but still majority have heard about Vanguard. So you've got your name around over the last 10 years then. Next question is, and this one you'll type in, what comes to mind when you hear the term ETF? What first comes to mind when you hear the term ETF or exchange-traded funds? Okay, so we've got stocks, funds, low cost comes to mind. low fees or no management, trading of some sort. Okay, okay. So we'll put the low fees and low cost pretty much in the same category, and index funds also comes up as well, and diversification. Wonderful. And which of the following features of ETFs is most attractive to you? Is it the liquidity in how it's able to be traded? Is it the diversification, the low cost, or the accessibility in the fact that it doesn't require high minimums in order to get access to this sort of product? So not a combination, but low cost tipping the scales at 50%. And then the final question is, do you currently invest or hold exchange traded funds in your portfolio? Okay. So some neck and neck with those who do and those who don't. All right. Appreciate the input. I think that will certainly help. And with that, I'm happy that we can have Surenanthan from Vanguard. It's been something that we've been talking about for some while. I've always wanted to have Vanguard share on their insights about ETFs, and definitely also the story of the company. That's also something that I think sort of helps to set the stage in terms of their experience in this space. So with that, I'll hand it off to Surenanthan, and so just unmute yourself and I'm pull up your slides. Right.
Oh, thank you, Orlando. It's great to be here, and I want to thank everyone who took time out of their evening to have this conversation. We'll take questions at the end, but if there is anything burning, please. I'm not sure if there's a Q&A button here or something, but we can try to get some of those questions going. What I want to do today, maybe over the next 30 to 35 minutes, is kind of walk you through who we are. Based off the polls, it seems a few people know who we are. You might be familiar with us in our time in the US, but obviously in Canada, we've been here just over 11 years now, Orlando. So we're coming up to 12. Okay. So it's a pretty good run. And so we'll talk about Vanguard, we'll talk about ETFs. We'll also, because one of the polls I did see a lot around low cost, and I think that's obviously something that gets attached to ETFs, but maybe something that most people don't know about us is just the fact that we offer both ETFs and mutual funds in that low cost format, right? To us, that's a very important thing. So since this is the first time that some of you are hearing from Vanguard, let me just quickly introduce who we are and our story, right? So we got a couple of key dates here. 2011 is when the Canadian office was founded. Back then, we had 6 ETFs, relatively small, I think about $1 billion or less than $1 billion in assets, and now we've grown to about 55 billion. I was employee, I believe, 32. We're now sitting at around 90 employees here in Canada. It's still a little bit of a drop in the bucket when you compare it to the US, right? So we had some US numbers here. We have quite a bit of individuals globally. We've been able to serve around 30 million clients globally, which I think we're very proud of. That story to Vanguard goes back to 1975. So that's when Jack Bogle, our pioneer, really wanted to start democratizing investments for most clients. And so today, when we sit here having this conversation, we talked about passive, we talked about ETFs. That's about 6.4 trillion of our assets. We have just over 1.7 trillion in active. So collectively, we're sitting at about $8.1 trillion. So quite a bit of growth in our firm overall. One thing that I'm very happy about is regardless of where you are in the world. So on the next slide, regardless of where you are, we have 19 global offices. The Vanguard approach and the philosophy has always been consistent, right? We want to serve end clients. We want to work with advisors like Orlando who really have clients' outcomes first and center, because that's really what allows us to grow in size at the end of the day, and it's really what allows us to be a low-cost operation. So whether you're sitting in Toronto, Frankfurt, Shanghai, Sydney, this view that we have is very much global in nature and it's consistent. So we have about 20,000 employees globally. Like I said, in Canada, about 91. We started with 6 ETFs. We're now sitting at 43 combined ETFs and mutual funds with about $76 billion in assets here. So what makes us unique, what makes us different for those who know us or don't know us? On the next slide, I think this is what gives me a lot of pride working at Vanguard is our core purpose at the end of the day is this, right? To take a stand for all investors, to treat them fairly, and to give everyone the best chance for investment success. And you hear that, and a lot of people will say, well, Surenanthan, no organization is going to say something else, right? No one's going to say we want to treat you as poor as possible, right? We're going to make it as hard as it can possibly be for investment success. And that's true. I think everyone's going to say this. What separates us is the next slide of how we're organized as an organization, right? And so we're not just saying this because it's great words to hear as a client, but the structure of Vanguard, essentially how it works is as a client, if you own any US fund that we have, that US fund actually in turn owns Vanguard. So it's a term that we call client owners. So everything that we can do in the grand scheme of things when it comes to an organization, it is driven to put money back into clients. And so when we say we're trying to give you the best chance for investment success and treat you fairly, it's because the way we structure this organization, there's no other option. So most companies, if you think about them, they're either owned privately. So there might be a family at the top that want to reap the rewards and the profits of an organization, or they're traded publicly. So you have shareholders, investment directors that you have to pay back. We're neither. We're owned by our funds. So if we ever have a profit at Vanguard, we can only do one of two things: to reinvest into the organization. And the Canadian operation actually is an example of this. So the US firm decided, let's bring out the Vanguard message globally. So the Canadian operation's investing. Or the other thing, which I saw quite a bit when it came to the polls, is lowering the fees of our funds. So we don't lower the fees because we have competitive pressure. We really lower the fees because our structure allows us to do so. And so that's allowed us to have very cheap mutual fund fees and ETF fees in the grand scheme of things, right? Now, the next
question, though, out of curiosity, is it that when the Canadian division versus the US, they sort of operate where the fees for the Canadian investors, because it's a 10-year run, that reduction in fee is based on the Canadian growth or the global?
Yeah, it's very much, that's a great question, Orlando. It's very much based off of the Canadian operation, right?
Okay.
At the end of the day, we are ultimately asked to give that money back to the U.S. And we have in a couple of slides, you'll see kind of this actually in action. But in the Canadian organization, since I've been here, I've been at Vanguard since 2017. Almost every year, we've lowered the fee on at least a ETF or a mutual fund. And that is seeing that growth in the Canadian business, starting from a little under $1 billion to now sitting at $45–50 billion, right? And so that's been a lot of that. The other thing I want to just call out really is just our investment principles have been consistent across any part of the world, right? We start with 4. I think they're very simple. And the next slide kind of speaks to some of this. The first one is trying to get the right goals. To me, this is where someone like you or Orlando comes into play, because as an advisor, what we've seen globally is you can help individuals get to clear, appropriate investment goals. I think a difficult part about investing sometimes is people don't know what they're working towards, and having those goals are a right start. We've always believed in balance. 2022 was a very difficult year for the stock bond correlation, or how stocks and bonds move. But we know that having a broadly diversified, suitable asset allocation is very important in ensuring that you achieve your goals ultimately. Costs. If there's anything I can leave you guys here with, is when it comes to Vanguard and cost, they should be synonymous, because that really is our core business. We want to lower fees as much as possible. From an investment standpoint, I think fees are best used when it comes to advice. Fees don't necessarily need to be high when it comes to products. We're a large organization. We're $8 trillion. We can take it a little bit on the chin, but that's where you can lower your investment costs. And the last thing is discipline. I mentioned 2022 was a very difficult year. I think having a long-term perspective and maintaining that discipline really allows investors over the long run reap the benefits of being invested in. So those are the 4 principles that we have when it comes to Vanguard product. So my current role is as a senior strategist on the key accounts team, working with advisors and our sales team. But prior to this, for 5 years, I ran product development at Vanguard. So any product we launched were based off these 4 goals, right? This is why you'll never see Vanguard launching a Bitcoin ETF or something that's thematic or in the current trend, because we want something that's long-term, disciplined, has that right balance, and can be offered in a low cost. And so that's really been our approach. The next slide, Orlando, I think it speaks to what you asked a second ago. What's that dynamic between our assets growing and our fees? And so this is an infographic that we tend to use. Back in 1975, when we launched in the US, fees were around 68 basis points, so 0.68%. We had just over $1 billion. Now we're sitting at 8.5 trillion, and our fees have come down to 9 basis points. And so this is the situation when you have an organization structured like the way Vanguard is. It goes back into the firm or it goes into lower fees. So that's a little bit of a brief overview of Vanguard and why we want to continue to help investors and advisors like Orlando get you to your end goals. So let's dive a little bit about the topics we want to discuss today, right? So ETF basics. Let's start on ground zero. And so oftentimes I think individual investors, they're not really sure what an ETF is. And so this infographic kind of shows where they sit between stocks and mutual funds. In a very simplified way, an ETF essentially is a mutual fund. So a mutual fund is a pool of securities, right? So stocks, think Apple, think Samsung, think Ford, any company that you know, the car that you drive, the tech provider that you have, they might have a stock, a publicly traded share of that company. A mutual fund is a pool of those. So now you have Apple and you have Amazon and you have Tesla. An ETF is essentially that mutual fund, but it's something that trades on exchange. So you can buy and sell throughout the day. So the way we look at ETFs is kind of an exchange traded mutual fund. They're the same vehicle, they just trade differently. So that's kind of the overview. The next slide kind of speaks to how they may trade differently from a mutual fund and an ETF. So to understand this, I think we should start with how a mutual fund trades, right? So on this next slide, what you'll see is if you want to buy a mutual fund, essentially what an advisor would do is, let's say you want to buy one, Orlando will be able to buy and sell a mutual fund. That trade is entered through a dealer, so in this case, RBC, and then all the buys and sells of that mutual fund from that dealer will be sent through something called FundServe, which is a back office type of platform, and that gets to the mutual fund provider, right? That mutual fund provider, whether it's Vanguard, whether it's someone else, they go ahead and create those units, and then they send it back through FundServe eventually to the client. So in a mutual fund structure, you deal directly with the asset manager. In this case, you would deal directly with Vanguard. An ETF, on the next slide, kind of speaks to how an ETF trades. So at first glance, it looks a lot more complicated, right? But what I'll say, it's not that difficult to understand. And so essentially, there's 2 different ways you can exchange an ETF. And so you can buy and sell similar to a mutual fund, but when it comes to an ETF, it can get traded on a platform. Orlando will be able to do so. And you don't necessarily have to go to the fund manufacturer. So in some cases, if you want to buy 100 stocks of an ETF and there's another seller who wants to sell 100 stocks, they essentially just swap positions. And so that way you don't have to constantly wait till all the trades get put in and then interact with the dealer. There's some benefits there. So what that means is you can trade throughout the day. It means that you can buy and sell depending on what the availability is. But let's say you are moving a lot of money and you want to buy a ton that's not out there in the marketplace. Similar to the mutual fund, you can interact with the asset manager. So what are the pros here? You can essentially do what a mutual fund does, but on top of that, you can trade a little bit more. And so this exchange of information being a little bit more automated, being a little bit more seamless, really allows trading ETFs to be a bit cheaper, right? And so that's one of the leading indicators or leading inputs when it comes to an ETF versus a mutual fund. So that's one thing of how ETFs and mutual funds trade. Now, the next thing I want to kind of touch on, and it was in the polls, because I think, Orlando, your question was when you say ETFs or exchange traded funds, what's the first thing that comes to mind? And we saw a lot of passive, we saw a lot of low cost. Being in the industry, what I can tell you on the next slide, what we'll see is that's no longer the case, right? And so ETFs they can be passive. And what do I mean by that? And so let's say, if you've heard of the S&P 500, that's a US broad benchmark. A passive ETF essentially would just try to match the performance of the S&P 500. But now we're seeing a lot of ETFs that are actively managed. So they're similar to a mutual fund, but the way they trade on that exchange is going to be a little bit different. So index ETFs, we're not trying to outperform the market. We're just trying to provide you market-like performance, right? And so you can fully replicate what the benchmark's doing. Active ETFs are now becoming a bigger part of the ETF infrastructure here in Canada, and they're really trying to outperform. So really what you end up seeing in those type of products is there's an opportunity to outperform, but that comes at a cost. And this is where someone like Orlando can help determine what part of your portfolio should be passive, what part of your portfolio should be active.
Can I say this, question?
Yeah,
maybe add something that just kind of popped into my head. I think, is it fair to say that the evolution of exchange traded funds, and the name was self-explanatory in the sense that, to be really clear on how this fund was different, and the fact that it could trade on an exchange the way a stock could trade on an exchange. But over time, it evolved, a lot more bells and whistles, and the name is not as, not so fully descriptive of it anymore, right? It's not just something that mimics an index the way the initial ones are going to be. And I'll tell you what comes to mind when I think about something else that evolved and is no longer, best described in the old name. It's this.
Mm-hmm.
We call this a phone, but it's probably like 5% really a phone, and it's like 95% something else. Right, but it evolved. It used to only make calls, and we still call it a phone. But this is, it's not really a phone. It's a computer that can, make calls, kind of thing. So that just kind of came to mind with how, the evolution and the name stuck. But sometimes you can get tripped up with the name because, should we really call this thing a phone anymore, or a mobile supercomputer that can make calls when needed?
Yeah, that's a very good observation, because I think exactly that, right? In years past, ETFs were synonymous with passive and index investing, right? But there was a fork in the road here where now ETFs aren't really just passive. It's just the fact that they trade on an exchange, right? And so that part's being leaned into more. For the clients and the viewers on the call here, what I'm very proud of being a Canadian is we started this, right? So ETFs, oftentimes, we get looked at as the younger brother, and trust me, I rub it into all my American colleagues' face. ETFs were born here in Canada, and that innovation, that growth in ETFs into active has really come out of Canada. So you might see the headlines, a lot more active ETFs in the US, but that's on the back of the growth in the Canadian market. And so there's actually no other market that has as many different type of ETF vehicles as Canada does. And so we've kind of led innovation. We started it, and now we're really expanding that. And so I think it's important to call out, just because oftentimes people just think to you what you just called out, Orlando, ETFs is purely just exchange traded. It's an index, but it's changed quite a bit, right? And so, comes with a little bit of due diligence, and that's where someone like you can really help a client understand what part of your portfolio should be passive ETFs, what part should be active ETFs, what part should be mutual funds, what part should be stocks, right? So I think that's an important consideration. Now, the other thing I want to talk about in terms of important considerations is oftentimes you get cost, and people think only the management fee or the MER. And for us, when we look at the next slide here, is just understanding the holding period. It actually matters quite a bit too. So in addition to the cost or the management fee or the MER, which stands for management expense ratio, you also have trading costs that come with an ETF. Right. And so what you really want to make sure is that you have a fund that's well diversified, that's easy to trade, Because if you have a fund that has a lower management fee, but every time you trade, there's quite a bit of a trading expense, ultimately the holding period really matters here, right? If you're not trading that much, maybe you want a lower management fund, but if there's a high transactional cost at the end of the day, you got to take that into consideration when you're building out an ETF portfolio. So a couple of things we're debunking. ETFs aren't just always passive, and they're not always a low-cost solution if they're not generated or constructed in a very efficient way. And so there's some costs that are associated with trading them. And that's really driven by what we call the bid-ask spread. So that example I gave you where someone might be buying or selling an ETF in the market, there's a cost to facilitate that trade. And ultimately, that's what that means. So kind of a little bit of an overview of ETFs, what makes them different from mutual funds, what's important when you're considering them. Now let's just talk a little bit about the ETF trading best practices. And I think this is kind of the fun stuff that people look at because there's a lot of analysis that goes into this. And what I've seen with a lot of clients, and then this is where advisors can help, is help with that paralysis that comes from analysis. There's a lot of information out there. What can you possibly do? And so this isn't by any means a complete list, but there's a few things that you want to do. And then the first part is really getting your homework done, right? Working with an advisor. What I just meant about trading costs, that's a big part of this. Because if we just went by management fees, it doesn't tell you the whole picture, right? And so you want to have funds that are typically well traded, that have low costs, both for management fees and trading expenses. And that way you can really buy and sell at any moment you want to. So I think that's the first thing you want to do. The second thing is there are certain periods in the day and certain markets that you want to just be a bit cautious about, right? And I'll give you some examples. The first one is market open. So for those who don't know, the market opens at 9:30 in the morning, Eastern Standard Time. That's why no one in Vancouver does any work, because it's 6:30 a.m. for them, right? But 9:30 is what you're going to have, and it closes at 4. What we would probably tell you is try to avoid those first 15 to 20 minutes. Why is that the case? Well, ETFs, they're trying to be trading very efficiently, but they're taking into consideration everything that happened from last night's close to today's open. So the market's going to move very fast in those first 10 to 20 minutes. So that's one thing I would say you want to try to avoid. Now, same as opening the market, closing the market really matters, right? Sometimes people are waiting for the last part of the day to trade. And so those last trading hours are very busy. And as a retail client or as a client with an advisor, sometimes that's where you can get taken advantage of. So I would avoid that. People say, well, Surenanthan, ETFs trade throughout the day. They're very efficient. So I should really try to get in there when the market's moving fast. I would say, please don't do that, right? Like that is usually when big money managers, institutions can take advantage of this. And March 2022, back to the start of COVID, is a good example of this, right? We saw the markets go crazy. And there's something that we call in the market called a market-wide circuit breaker. So think about the power in your house. If you have too much electricity running, it's going to break your circuit and everything shuts down. That happened during March 2022, 4 times, right? And so when the market's busy trying to get in and out of it, you're not going to get the best possible prices. And so that's something that you just want to be careful of. So don't try to trade ahead of the market. It rarely ever works. We have a saying at Vanguard, instead of timing the market, it's the time you're in the market that matters. And so long-term investing actually pays off a little bit better. And the last thing what I'll say is around cautious periods is sometimes you want to invest in international markets or bonds that are other places from the US and Canada. We have similar time zones. And you really don't want to be trading too much when those markets are closed, right? Similar to what I was saying, market open, market close. If you want to trade a stock in Japan or South Korea, our market's not going to take that into consideration until that market opens up again. And so those are periods that I would say you want to avoid at the end of the day, right? And so those are a few things I'd be cautious around. And the last thing.
Clarify though, I think it was March 2020 you meant, right? No,
March of 2020, I'm sorry. Yeah. March of 2020 during the peak of COVID, right? It feels like it was yesterday and 5 years ago at the same time. Sometimes those dates get messed up here for me. And the last thing I think is around limit orders. And so on the next slide, we can kind of speak to the different types of orders you would have available for you. So there's 2 orders. when you want to protect the price of your ETF trade, and this is, you know, the stuff that we talked to Orlando about, making sure that when he's adding positions into his clients' portfolios, is really using a limit order. So that's essentially you saying what price you're willing to pay for. Why you do that is because you know exactly what that price you're going to fill on is. Whereas a market order is kind of all the reasons why I told you to be cautious a second ago. You know, the market's opening, it's moving very fast. You get the price that the market determines, right? And so this is something that really trips up a lot of individuals when they're coming to ETFs. It's, if I can tell you one type of way to transact, our advice is really where you want to be, limit order at all times. You're not always going to get execution, but at least you'll get the price that you had signed up for, right? And so that's a big part of it. And so on the far right of the slide, you kind of see things to consider. But with a market order, there is no price protection. You get what the market gives you. And so that matters a lot when you're trying to transact in ETFs. So it kind of speaks to essentially how an ETF is traded and what makes, what are the important considerations when you're buying and selling ETFs. Even for investors who try to invest on their own, I think this is something that trips them up. And so this is where really some financial advice and guidance around the market really can take you a longer way. So that's essentially the ETF component of what we're talking about today, right? And so I'm going to pause here, see, Orlando, if you have any questions. Maybe if there's any questions from the audience, we can take those. But then in the next little 10 minutes, while I still have you guys, maybe just speak a little bit about our active history that often gets overseen. Okay, let's jump right into it.
Yeah, and then we'll do the Q&A on the tail end.
Perfect. So these are three facts I try to start off with when I talk about our active franchise. It's been something that Vanguard's been doing for 45 years. So in a previous slide, I told you 1975 is when we started as an organization. Well, when we started, actually, they were all active funds, all 11 of them, right? And so we've actually been doing active prior to doing passive as an organization. That really doesn't matter if you don't have a large active organization right now. And so today, as we talk, it's about $1.5 trillion. To put that in perspective, that's actually larger than the entire Canadian mutual fund industry, right? So we've been doing this for 45 years. We started with active, and really what's allowed us to be successful is our approach of finding the best managers in the world. And so if you want to actually just jump a few slides, Orlando, you can just pass this right to the next one. This is really what's allowed us to be successful. If you want to just go back one around what our active franchise has been. There's three things that has allowed us to outperform on our active side, whether it's whatever time period you're looking at, 3, 5, 7, 10 years, our active funds tend to outperform. It's been three things. We work with the best talent that we can find globally. When you're $8 trillion like Vanguard, we're able to find the best money managers in the world. But in addition to finding the best money managers in the world, I think what is the number one determinant of success, whether you're talking about passive ETFs or active mutual funds, is cost. If you have a high hurdle when it comes to costs, active managers tend not to outperform. We've seen all the studies, right? I think I'm a relatively in shape individual. I could probably clear 1 6-foot hurdle, maybe 2. When I get to the third one, I'll probably trip up. But if you gave me a ton of 1-foot hurdles, there's a very good chance I'm going to clear them, right? Because I'm not going to overextend myself. I'm not going to take more risk to clear those. And that's what we've seen when it comes to active managers. And the last thing is patience, right? Everyone was a great growth manager during COVID. You saw all the names grow. And then everyone was a really bad growth manager in 2022. So whenever you hire an active manager, you got to be patient with their investment style. So I mentioned passive investing. The S&P 500 is one of the largest index products in the world. That's going to give you U.S. exposure more on the growth side. You have an opportunity to round that out with some more U.S. value. And so I think if you find an active manager, you want to make sure that they're well-resourced. You want to really make sure that they're low cost. And then you want to make sure you have the patience to ensure that there's long-term success. And so the next slide is how we evaluate these companies and firms. This industry very much is a people business, right? Everyone can have quantified numbers and all that. And if, to be honest, if I could predict the market with a high degree of certainty, I probably wouldn't be on this call with you, Orlando. I'd probably be on a beach somewhere. And so we don't drive based off past performance. We really look at the qualitative stuff. It's the making sure we have the right firm that we're working with, making sure that the people that we work on those firms have a good succession plan in place, right? You know, when we think about our own families and our legacies we're leaving for our children, we want to make sure that there's something there for that next generation. That thing still applies when it comes to portfolio managers. We want to make sure the PMs have a next generation of money managers. We want to make sure the philosophy is well spoken to, and then the process is one that's repeatable. Because if the process isn't repeatable, you essentially become more lucky than skilled. In September of 2020, I couldn't find someone who couldn't pick a great stock. Everybody who was in the stock market in 2020 found, 10 baggers in the industry. When you said about something goes up 10 times, I couldn't find those great stock pickers in 2022 though, right? It's very hard. And so I think having a good process and one that you're committed to on an ongoing basis is really what determines if someone's lucky or skilled. This is the process that we follow at Vanguard, and this is what the team that I was on really looked at on an ongoing basis. And so that's allowed us to see quite a bit of growth in that world. We can kind of touch on the next little bit here in terms of talent. I don't want to spend too much time here. There's a couple of names that you see in red. These are the asset managers that we brought over to the Canadian lineup. The way we structured this slide is really the top left is the firms that we've been having our longest relationship with, and the bottom right is the firms that we just recently added onto the team, right? On average, our relationship is 15 years with a sub-advisor, and Wellington goes back to 1975. So really, we're trying to bring the best possible sub-advisors to our Canadian advisors and ultimately our Canadian clients.
Lots of collaboration as it relates to the knowledge, not only internal knowledge, but collaborating with other firms.
That's exactly it. And what we want to make sure is when we have our funds, they often use two of these managers. And what we want to do is have them do what they're best at. And so, you're good at financial planning. You're good at helping clients come to their end goals. I'm not sure how great you are on some of the other things that you want to do in a grand scheme of things, right? And so if I'm good at that and you're good at that, there's no point of both of us, but let me help you round out your skill set, right? And that's how we know good financial advice works, but that actually works with portfolio management too. If you have two advisors who do something slightly different, you put them together, you actually have a better, well-rounded portfolio, right? In your poll earlier, you saw diversified when it came to passive, right? That was a thing that came up. How we pair active managers is to diversify their type of approach as well, right? So while it's not the same thing as passive investing, we know that keeping costs low and being diversified, even in active, does help over the long run. So I think that's a big part of the talent we have and that different diversity of talent ultimately. Now, talent's the first thing I said that was very important. Cost is the second thing, right? And so our next slide kind of speaks to where we're a little bit lower than the industry average. I think my compliance team has forced me to put 25%. I would say our mutual funds often come in half the price of what you'll see in other mutual funds, right? And I think a lot of that is the growth that we've been able to have in the active space and the relationships we've been able to build by collaborating with those sub-advisors that you saw on the last slide. And so that's kind of a little bit of an overview of our active component. So we spoke a little bit about Vanguard. We spoke about ETFs. We spoke about active. I think the last thing I want to leave you guys with is really why I want to be on the call today and why we work with Orlando and other really good advisors, because we've done a lot of independent research when it came with working with advisors and the idea of something called advisors alpha, right? For those who don't know, alpha is a term that we tend to use in the investment landscape when you're trying to outperform something. So, passive funds are not supposed to have alpha. They just meet the benchmark. Active funds are supposed to have alpha. What I've told you before, on the fund side, you want to lower your costs because your alpha may not be guaranteed. I think where advice comes into play is really helping you increase your overall performance. The next slide kind of speaks to where we've seen the value when it comes to advisors, right? This is research we did in the US. We echoed the same research in other parts of the world, so whether it's the UK or Australia. And what we saw is, on average, working with a financial professional tends to allow investors to get 3% more a year. So where does that money come from, right? A few things. I think There's the easy parts. So that's kind of the things that you see on the bottom here, the rebalancing. So if you're a client who's a little bit older, you get an advisor to help you rebalance to more fixed income. There's some asset allocation, but it really is around spending strategies. So maximize your after-tax returns, but behavioral coaching. There's going to be times where you don't like Orlando because he's going to tell you to do something, but I can tell you that's probably the thing that you want to do, right? And it's often what people don't tend to do. And so I think behavioral coaching and spending strategies, that's about 50% of the advisor alpha that we've seen over the years. And so when you focus on these things and you look at the efficiencies of a practice, that's really where we've seen success at the end of the day. So the next slide kind of speaks to that a little bit as well. But these are the things that I think an advisor, working with an advisor, can help you really understanding the accounting, the estate planning, the trust services. As you're thinking about your own legacy and the next generation, I think charitable giving, also family-owned businesses, this is where you can build most of your time and working through those things, right? You get the investments done by an asset manager like us, and this is where financial advice can really help you focus on your clients. And the last part is help you figure out what the right asset allocation should be. And our next slide is what we call the investment quilt. It speaks to the different type of products out there, right? And you'll see the colors all over the place. So it's really, really, really hard to find what asset class you think is going to outperform over the long run. And so instead of trying to do that, it's important to go back to those 4 core principles that we had at Vanguard. Have clear goals, have good balance in your portfolio depending on your financial situation, lower your costs, and be disciplined. And I think all 4 of those things can be well done when you have a right financial plan in place. And that's allowed most of the clients that we have, and with that, whether that's with advisors or not, help them get to their end goal that they want to do. And I think this slide kind of speaks to the difficulty of trying to time the market, right? It doesn't really work out. You rather just focus on those 4 things that are actually very controllable from your end. I think with that, we've come to the end of the presentation. I've stayed very true to the time you gave me, Orlando. I think we're just at 7:46 here, but I hope you learned a bit about Vanguard as an organization. I think what we're trying to do as a low-cost provider. I hope you learned that low cost is not just in ETFs, it's in ETFs and mutual funds. I think they're both useful tools as long as they're low cost in nature. There's been a lot of growth in ETFs, so I think that's good to incorporate those into your portfolios, but really focusing on your long-term goals, having the right balance, having the right discipline, and keeping your costs low should really help you focus on the things that are important when it comes to financial planning.
Yeah, no, appreciate it. And I'll add, because even the concept of advisors alpha came directly from Vanguard, and I found that I'll share this. This is something that I'd gotten from your firm, and just the fact that you focus so much on low cost, saving investors on what they pay for investments, but at the same time you're always championing that there is a lot of value in a lot of the things outside of investments. And I mean, if I were to look at this, and we talked a lot about the left-hand side, right? About the portfolio piece. This is where, and if I were to walk through some of these, I can pull up different clients mentally and actually find a story where we were able to, one, help them navigate some sort of real estate transaction, right? And that was something that brought value to the family. So helping a widow, her 2 young children, purchase their own 2 properties, despite her being, a single income earner, helping her 2 children get their own assets in the GTA, which is, everybody knows, an expensive market. But being that steward, connecting the dots is something that I don't know what price that client would put on that. The fact that there's a peace of mind in knowing that her children have gotten sort of into the market with that kind of help. A lot of things that even here as well, a lot of connections with accountants. I'm actually in the middle of that right now. We're trying to connect a client who's got serious tax issues, pays a lot of taxes, and not just, he does have an accountant, but that accountant is not equipped to put together a structure that we're trying to assist them with. So leveraging the relationships to bring a different accountant to the table to then help him to save on taxes, significant amount of taxes. So again, what I'm going to do after the webinar, I'll pass this on to everybody who's joining, as well as there's this research that Vanguard put out a couple years ago, 2019. That way, you're not just hearing it from myself, you can read this data on your own. But I'm sure there is one hand up, so I'm going to, pause here, allow people to sort of questions that they might have from what you shared, and then certainly happy to sort of hear, what were the things that were top of mind. You've got a hand up. Let me just stop sharing here real quick. Don't quote me on it, but I do believe that there will be a commission on the purchase, because there is a commission on a purchase of a stock. It's probably $9.99. I think it would be the same for the ETFs.
Okay.
But I'm not at the directed investing area, so my finger's not always on the pulse. But if I were a gambling man, I would lean towards that response.
Okay.
But something that, not 100% sure, but I do think so. Yeah, no, or is it more so? So I think, is it a question in terms of for a self-directed investor, how do they tap into the value of an advisor as well? Yeah, you know what? Okay, here's how I can answer that question. So in terms of within the landscape, there are some advisors, and a lot more in the US than here, that will fall into the category. They focus a lot on direct investing or do-it-yourself investors. So you won't get assistance from them on a portfolio side of the picture. They're fee-only advisors. So you might pay them per hour. They might charge a fee for the plan. It ranges. I know a few that are here in Canada, and it might be very specific. So you might want to get a financial plan done or a review of your taxes, but they're not going to assist with the investment side. So there's a few that do exist in Canada. That is sort of where that's the gap that they sort of fill for the client that wants to do their investing on their own. On my side, I'm a full service advisor. So we're helping with the investments, we're helping with the tax, the estate. For clients that sort of say, for whatever reason, either the time or the interest, I don't really want to be in the weeds of this. Right? I don't want to be at the steering wheel. I want to sort of, be driven from A to B. And that's sort of what they want, right? They don't want to necessarily be watching the news to see, well, what happened with Dollarama today? Do I need to do something with my portfolio because I just saw something on the news about, X company doing layoffs or this sort of merger happening? There's a lot of clients that would rather use their time either in their, profession or their passion or their family. And that's sort of where we exist. But again, you do have the option. And again, people go from one to the other. Sometimes at a stage in life, they want that. And another stage, maybe they have the time now or the interest, they want to do it themselves. So it varies. So it depends on where you're at and what you're really looking for. But I can certainly shed light on that in terms of the advisors I know who operate on a sort of fee-only basis, and they don't assist with investments. So that's sort of where, Okay.
Thank you.
You are most welcome. All right, let me take another quick look. All right, so we've got another question, and it's just RS. Yeah. Okay, you want to say that? I've got an answer to that one. And who's the question directed towards? Okay. All right. Let me sort of touch on something. So the question that you're asking is about one, we'll refer to it as asset location. And I'm going to share on my screen something real quick where we sort of suggest that depending on the kind of tax vehicle, so let me know if you can see my screen here, we'll suggest holding certain investments in an RSP while avoiding holding other kind of investments in that. And again, same thing for a tax-free or for a non-registered account. At a very high level, typically when we're putting together a portfolio, we're also thinking about where best to hold Canadian stocks, for example. We typically try to hold most of our clients' Canadian stocks in their tax-free savings accounts. When we're looking at US stocks, we typically try to hold those in their RSPs. And part of the reason for that is there's some tax treaty between the US and Canada, and they recognize RSPs. So when you have a US stock in an RSP and they pay a dividend, there's no withholding tax on that. But if you hold that same stock in your RSP, there is withholding because the US doesn't recognize the tax-free savings account as a tax shelter the way they recognize RSPs, been around for a long time, similar to their 401ks. So those sort of are some of the reasons why we'll lean more towards holding US stocks in an RSP, holding the Canadian stuff in a TFSA, and in a non-registered, we're typically trying to hold most of the fixed income because that's fully taxable. So we don't really want a lot of the growthy stuff, a lot of the things that will appreciate a lot in value from, you buy at $10, it doubles or triples. We don't want to hold too much of that in the taxable account. So there is a sort of strategy towards that. It's documented, and I can pass this on as well. That sort of highlights, where to hold certain kind of assets to be more tax efficient, which we, kind of refer to that where to locate some of these assets. So hopefully that quick summary kind of touches on it, and then I can kind of pass this on as well to kind of get into a bit more detail. But that was a good question.
Maybe I can take that one, Orlando, being part of our suite. I think that's a really good question. VOO, so kind of Orlando spoke to the different accounts, right? So RRSPs being recognized by the U.S. treaty. I think that's an example where VOO could be beneficial because of the withholding taxes, where you may not get that in the VFE structure. Now, that's the only place where I can see that making some sense, right, in that type of vehicle. But ultimately, what I'll tell you is there's foreign exchange transaction fees that you end up having, right? And essentially, do you think you're going to get a better price through your brokerage or through anyone you're working with, or do you think that it's going to be a little bit easier just to manage that from an asset manager perspective? We often find that it's at the end of the day, if you're making multiple purchases into US ETFs, you're probably better off with the Canadian ETF in the grand scheme of things, right? Especially outside of the RRSP type of structure. And so that's kind of how we've seen it in the past. But then this is where asset location, to kind of what Orlando's talking about, might make sense for the advisor, because then you can pick which type of securities you want and which accounts over a broader spectrum. But generally speaking, what I would tell you is, even though the fees tend to be lower on the US side, the transaction costs from foreign currency washes that away. That's been our experience over the 10 years that we've been here in Canada. And I think that kind of speaks to our growth, because otherwise people would have just bought the US versions of it. There are some benefits of having the Canadian domiciled component of it instead of the US domiciled. I hope that helps.
All right, thank you, and appreciate the question. And I'm just looking at the time, and I will quickly just then touch on what we've got coming up. So in terms of the next webinar that will be coming up, that's going to be in September. We're going to be looking at a webinar focused on some of our other money managers, specifically from a stock point of view. So US stocks, Canadian stocks, and something that we've done in the past, but this time we're looking at small cap Canadian stocks. So not your large institution that everybody knows, not the the big banks and the Metros of the world and the TELUS of the world, but the up and coming institutions or medium-sized Canadian companies. Because again, if you think about it, there was a point where a Shopify was not known about, not in the mainstream, or a BlackBerry. And there are companies that are not household names, I'm going to call them, but they are leading in their space. And that is something that we typically look at getting clients exposed to after they've gotten exposed to some of the larger names. So that's what we're going to look at in September. And then in November, there's a webinar we're looking at called Noted Principal Protected. So essentially looking at ways that clients can protect their principal over and above just a GIC. And GICs certainly have, become a lot more attractive in this high rate environment. And there are other ways that we can do that using what's called principal protected notes. And we're going to go a little bit deeper into that, just to sort of provide the awareness on these other options that are over and above a GIC and over above a fixed income vehicle. Right, so keep an eye out for those. And as always, call to action is one, don't hesitate to reach out for a question. Typically, if I don't know, I might know somebody who does. So I really try to connect and to surround myself with people that are experts in their space. And what people appreciate is that we're able to provide solutions. And we may not be doing it directly, but we're doing it indirectly by bringing the different brains to the table and getting the job done in a more efficient way, in a timely way. Because I think these days I've sort of said that sometimes I find for a lot of clients, money is something that is easier for them to find than time. Right, time is just a hard thing for people to find these days, and if we're able to one, reduce the effort that they have to put into one, getting things done, that's where that value add sort of comes in. And always willing to give a second opinion on strategies that people have in place, and if there's anything that they've been overlooking. Right, so one of the things that I really do when I connect with individuals is to find out what you don't know. Right, that's sort of where I'm able to then figure out things that you might not be aware that you're overlooking at or that you haven't explored. The purpose of these webinars is those three key pillars: education, empowerment, and execution. So getting you to become aware of certain things, and then if there's value to it, well, how do we help you to execute on that, right? In a timely manner and in an efficient manner. And all of that, again, kudos to everyone who joined this webinar on a summer day. Hopefully you definitely learned something, one or two things that's new to then sort of apply. And the process, again, is something, first to connect with individuals, see what they're doing, and then to sort of, almost as if I'm looking at your chessboard and seeing what move you are going to make next, and to highlight other options that you could take. And with that, I want to bid everyone farewell. I want to really thank folks at Vanguard. Surenanthan, thank you so much. Good insights. It's been a while coming that I wanted to kind of have Vanguard to sort of present. I'm gonna say probably even before the pandemic. That's how long I've been. And again, the stars kind of aligned for it to happen now. But yeah, it's always been something that I've wanted to sort of bring the story of Vanguard to more people. And with your help, with the help of your team, we finally kind of got to make it happen across our two institutions. So that whole collaboration, making the compliance departments for each institution happy. So with that, I'm going to sort of again bid farewell to everyone, and I'll hang on for a little bit in case anybody has any other question that might relate to what we talked about today, or just anything in general. All right, but stay safe, and thank you for joining.
Thanks for having us, or thanks for having me as well.
Yeah, appreciate it. Take care. Bye.